Hey everyone, welcome to your first lesson. My job today is to teach you all the basics, and when I'm done, you will literally have everything you need to start repairing credit. But first things first. In order to get there, I want to make sure everyone understands what credit actually is, so we're going to start with the easy stuff here on lesson number 1. We're going to start with a little history lesson on the credit system and why credit is just so important. I'll break down the elements of what a credit report really is. We'll talk about how credit scores are calculated and how debt impacts your credit. At the end, I'll share some tips on how to optimize your scores. Then afterwards, we'll get into a more in-depth lesson on repairing credit. Fair enough? All right, this is going to be awesome. Let's do it. So, what exactly is credit? The real definition of credit is the confidence in a purchaser's ability and intention to pay and entrusting the buyer with goods or services without immediate payment. In order to track all this data, companies use credit reporting systems and credit reports. Companies use these systems and reports to decide whether or not to give credit or a loan or how much interest they're going to charge you for it. Your credit report is based on the bills you paid, missed, or been late paying, loans that you've paid off, plus your current debt amount. Your credit report contains information on where you work and live, how you pay your bills, and whether you've been sued or whether or not you filed for bankruptcy. Credit reporting agencies, also called credit bureaus, gather this information and they sell it to creditors, employers, insurers, and they even sell it back to you, the consumer, in the form of credit reports and credit scores. Credit reporting began more than 100 years ago. There's some basic dispute on who started it and where, but the approach was basically the same. In the late 1800s and early 1900s, several individuals in different cities began going from merchant to merchant, taking notes about the people with whom they had credit arrangements with. Those notes could say anything from, he's a reliable customer and always repays his debt, to, he won't pay but his father's going to cover what he owes. When a consumer would ask for credit from a merchant, the merchant would call the local credit reporter who would share the information they had on file about that person. So, over time, credit reporting became purely objective and came to include only account payment history. It also grew from a local business to a major national industry. In the late 1960s, credit reporting became computerized, which made it possible to become truly national in scope. In 1970, the Fair Credit Reporting Act, also known as the FCRA, became the very first law to govern consumer reporting, including credit reports. The FCRA has been amended several times but remains the primary national law governing credit reporting. It specifies who can get a copy of your credit report, under what circumstances, and most importantly, what the credit report can actually include. It also defines the responsibilities of credit reporting companies and the responsibilities of businesses that choose to report information to the credit reporting companies. Most states also have laws that regulate credit reporting. The laws recognize that lenders need credit references to protect their businesses from losses and provide better services to their customers. By sharing credit payment information, lenders are able to make better decisions and make credit more available to more people at a lower cost. And like no other reference service, consumers have full access to the information that's shared. So, why is your credit so important? Your credit is like your reputation. Once you mess it up, it takes some time to rebuild it. Your credit impacts virtually every aspect of your life. At least most people don't have cash to purchase everything. It's just the way it is. Your credit score is a direct reflection of what risk you are and how much you'll pay in interest. If you want a home or a car, credit is the first thing the bank will ask about. If you're looking for a personal loan or a business loan, same thing. What's your credit score? Homeowners insurance, car insurance, even life insurance companies are now pulling your credit. Employers look at your credit, especially for jobs with any type of financial responsibility, will want to see that you are financially responsible, and your credit is the best way for them to determine that. Nearly every opportunity in life is affected by your credit. So in short, your credit is extremely critical and impacts everything. Here's some really interesting statistics regarding credit reporting. Approximately 79% of all credit reports contain serious errors or mistakes. Over 61 million Americans have subprime credit scores below 650. Nearly 33 million Americans do not have enough credit to even generate a credit score, and 24 million Americans have no credit file at all. And last but not least, most consumers in the US have no idea whatsoever how to get a copy of their own credit report. That's pretty crazy when you think about how much your credit impacts your life. Let's talk about the three big bureaus. I'm going to start with the basics. There are three major credit bureaus and nearly 1,000 smaller bureaus. Make no mistake, credit reporting is a big business. TransUnion is based in Chicago and provides service to approximately 45,000 businesses and approximately 500 million consumers worldwide. It's also the third largest credit agency in the US. Equifax, on the other hand, was founded in 1899 and it's the oldest of the three agencies. They gather and maintain information on over 400 million credit holders worldwide. They're based in Atlanta, Georgia. Equifax is a global service provider with over 7,000 employees in 14 countries. Finally, Experian's the largest of the three. They're based in Ireland and they employ over 17,000 employees. Their revenue last year was over $5 billion. Towards the end of this course, I'll explain some facts about these three credit agencies that will literally shock you. Even though there are many different bureaus, all credit reports have the same basic structure and anatomy. You'll find your personal information. This includes your name, potential aliases, your date of birth, your social, current address, your previous addresses where you've lived, and employment information. You'll find negative accounts. Negative accounts are anything that wasn't paid or paid late. These are items that you do not want on your report because they lower your score. Also, items that you do want on your credit report are positive accounts. Positive accounts are essentially any accounts that have been paid on time. They help your score. You also may find public records on your credit report. Public records are typically court documents such as judgments, liens, bankruptcies, child support, and even sometimes criminal histories will show up in the public records section of your credit report. Another thing you'll find are inquiries. Inquiries are a record of any time your credit report has been requested or pulled. There are several different types of inquiries, and each have different meanings. I'll be explaining this in greater detail in a few minutes. You can also find a consumer statement section on your credit report. Consumer statements, to me, are ludicrous. I say that because essentially it's an area on your credit report that allows you to place 100 words or less an explanation about something on your credit. From my experience, adding a consumer statement never helps. If anything, it can make you look guilty for something a lender wouldn't have even wondered about until you mention it. The last thing that you'll find on your report is furnisher contact information. Furnisher contact information includes the names, addresses, and phone numbers of all of the companies that have reported information about you to the credit bureaus. This information is kept available to you, the consumer, so you're able to contact anyone that reported any information about you. Let's talk about the negative items and red flags. First, high balances. One of the most important aspects of your credit score is the level of credit card debt, measured by credit utilization. Having high credit card balances relative to your limit increases your credit utilization and it decreases your score. The more debt you have, the more of a risk you are. Next, late payments. Did you know that 35% of your credit score is payment history? Being late on payments will hurt your credit score. Consumers often send a payment on time, and late payments show up on the credit report because of clerical errors, mail delays, or simply due to sheer incompetence. These late payments can cause severe damage to credit reports and cost consumers thousands of dollars in unnecessary interest. Let's talk about charge-offs. Sometimes you may see the term charge-off on your credit report. This can be confusing to many people because it almost sounds like it's a debt that isn't owed, but that's not the case at all. As an example, if you're late paying a credit card, after a few months, typically 3 or 4 months, the creditor begins to lose hope that you'll ever pay the account. The reason is, statistically speaking, you won't. The longer you go without paying, the more likely it is that the account will never get paid. Now, try to wrap your head around this. Creditors and lenders pay taxes on your debt. That's right. Your debt is considered an asset in the government's eyes, and the lender will continue to pay these taxes until the debt is either paid or charged off. So, after about 90 to 120 days, creditors will typically report the debt as uncollectible to the credit bureaus and the government, which will allow the creditor to stop paying taxes on the debt as an asset for the company. This does not mean you no longer owe the debt. It just means that the creditor believes that the debt is uncollectible. At this point, the creditor will typically either sell the debt to a third-party debt collection agency or in some cases lease it to a company that will try to collect it. Meanwhile, the account is on your credit as a negative item called a charge-off. Next, repossessions. If you're ever late paying a car or a boat or an RV or any of those type of vehicles, it can get ugly. The creditor or lender will usually seize the vehicle, take it in the middle of the night, or show up at your front door and take the vehicle, and then they'll sell it at auction for a fraction of what is owed. Then they sell the balance to a collection agency, and you're left owing the deficiency balance. Next, bankruptcy. Bankruptcy will typically devastate your credit reports. Bankruptcy or insolvency is a legal status of a person or an organization that cannot repay the debts that are owed to the creditors. Creditors may file a bankruptcy petition against a business or a corporate debtor, which is called involuntary bankruptcy, in an effort to recoup a portion of what's owed or initiate a restructuring. In the majority of cases, however, bankruptcy is initiated by the debtor, a voluntary bankruptcy. That is filed by the insolvent individual or organization. An involuntary bankruptcy may not be filed against an individual consumer debtor who is not engaged in business. Judgments and liens. So when a judge or a government orders you to pay a debt or places a lien on you, this is not a good sign to lenders. So you definitely do not want judgments or liens on your credit report. Next, inquiries. When consumers apply for credit, they authorize those lenders to ask or inquire for a copy of your credit report from the credit bureau, and an inquiry appears on your credit report. Inquiries are often placed on credit reports by businesses that the consumer did not apply with. Multiple hard inquiries negatively affect your credit score. Not only will your credit score suffer a few points of damage for each inquiry, you may appear credit desperate and risky to lenders. The only inquiries that count towards a consumer's credit score are the ones that result from applications for new credit. Most inquiries only impact your credit scores for a year, some of them up to 2 years. Next, a foreclosure. This is when you stop paying on a mortgage. Foreclosures have recently skyrocketed after the collapse of the subprime mortgage industry. Foreclosures are extremely negative and usually high dollar amounts considering it's real estate. Next, duplicates. Duplicate entries are instances where a particular situation shows up more than one time on a consumer's credit report can make it look as if they have more than one debt or credit issues than they really do. This can negatively affect chances of getting a loan or having credit extended. Some of the most common duplicate, triplicate, or even quadruplicate entries are medical bills, student loans, utility bills that have been sold to multiple collection agencies, and any other item that gets sold and resold may show up as a duplicate or worse. Other factors that impact credit scores negatively, one is debt. The more debt you have, the higher of a risk you are to lenders, and the lower your score goes. Simple as that. Next, let's talk about not paying at all. When you're late on a bill, it's not good, but when you completely ignore your bills, that's much worse than paying late. Each month you miss a credit card, auto loan, installment account, or a mortgage payment, you're 1 month closer to having the account charged off. As we discussed a few minutes ago, eventually the creditor will consider the debt uncollectible and either sell it or lease it off to a third-party debt collector. We have seen thousands of instances where the original creditor continues to report the entire balance, then an additional collection item appears in the collection section of the credit report. This causes duplicates, triplicates, and quadruplicates, and excessive and incorrect balance amounts. Last but not least, when you have accounts sent to a collection agency. Creditors often use third-party debt collectors to try to collect payments from you. Creditors might send your account to collections before or after charging it off. A collection status shows that the creditor gave up trying to collect a payment from you and hired someone else to do it. It's very negative, and you definitely do not want that on your credit report. Now that you know what can hurt your credit, let's discuss what will actually help it. These positive items will increase your scores. To start, low balances are obviously better than high balances. Keep this important piece of information in mind throughout your life. Every dollar of debt you owe is considered a risk factor. The more debt you owe, the more likely it is that you will not repay it, and every dollar of debt will hurt your credit. This is a catch-22 for most people because you need to borrow money to build credit, but borrowing money hurts your credit at the same time. There's an old saying that goes, banks are only interested in borrowing money to people that don't need it, and boy is that true. Next, on-time payments are always going to be good. Doesn't matter if it's a credit card, a home loan, auto loan, student loan, or whatever. Pay it on time, and it's a positive factor that will only help build your credit. Next, aged accounts. The older your open accounts are with positive credit history, the more likely it is that you'll continue to pay on time, and therefore, old open accounts are positive and will improve your credit score. Next, of course, you always want accurate information. Not only accurate information, but just as important, your personal information must also be correct. There's a few reasons for this. Your name, for example, if you have multiple aliases or misspelled first, middle, or last names, lenders may consider you a higher risk because it may be a sign that you are not who you say you are and possibly be an identity thief. Or how about your employment information? If you're applying for credit, insurance, or a job, and your employment information is incorrect or inaccurate, or it's different from what's on your application, that's a big red flag. There are many other instances such as your address, your social security number, your date of birth. You need to make sure they're 100% correct and accurate. Finally, let's talk about diversifying your credit. Lenders like to see that you're able to handle paying different types of accounts. This means mixing it up. Having a mix of credit means that you have different types of accounts reporting to the credit bureaus. With that being said, for example, if you only have installment loans, that can hinder your ability to get a home loan because your credit is not diversified. You'd be much better off showing that you have experience paying installment and revolving accounts as well. So, what are credit scores and how are credit scores calculated? I personally think credit scores are just adult GPAs. Seriously though, your score is your financial reputation, and banks, lenders, employers, insurance companies, and others take your reputation seriously. There are many different types of credit scores. There are literally thousands of companies that sell their own white-labeled credit reports, and most use their own scoring models that were made up by them. So the score you get from one place to the next will typically be very different. Regardless, the scores are intended to help you gauge how good or bad your credit is. But more importantly, it's to help the banks, lenders, and other companies make complex, high-volume lending decisions about you. Let's discuss how scores are calculated. So the biggest chunk of your credit score is primarily payment history. This is approximately 35% of your total score. When you're late or you miss payments, it obviously impacts your payment history and lowers your credit score. In general, risk scoring systems look for negative events like charge-offs, collections, late payments, repossessions, foreclosures, settlements, bankruptcies, liens, and judgments. Within this category, credit scores consider the severity of the negative item, the age of the items, and the prevalence of negative items. Newer is worse than older. More severe is worse than less severe, and many are worse than few. Basically, not paying on time can devastate your credit scores. Also, debt is a huge factor and accounts for roughly 30% of your score. Scoring models consider the amount and type of debt carried as reflected on your credit reports. There are 3 types of debt considered: revolving, installment, and open debt. Let's talk about each type of debt because it really does matter. 1. Revolving debt. This is usually a credit card, retail card, merchandise, or gas card. Basically, if you use it, then pay it, then you can use it again, it's considered revolving. The most important measurement from this category is called revolving utilization, which is the relationship between the consumer's aggregate credit card balances and available credit card limits, also called open to buy. This is expressed as a percentage and is calculated by dividing the aggregate credit card balances by the aggregate credit limits and multiplying the result by 100, thus yielding the utilization percentage. The higher that percentage, the lower your score will be. This is why closing credit cards is generally not a good idea for someone trying to prove their credit scores. Closing a credit card account will reduce your total available credit limits and likely increase the utilization percentage unless the cardholder reduces their balances at the same pace. Next, installment debt. This is a debt where there's a fixed payment for a fixed period of time. An automobile loan is a great example as you're generally making the same payment for either 36, 48, or 60 months or longer. While the installment debt is considered in credit scores, it's not nearly as important as revolving debt and holds far less weight. Installment debt is generally secured by an asset like a car, a home, or a boat. Consumers will typically make a far greater effort on secured accounts to make sure that their payments are on time, so their asset isn't repossessed by the lender for non-payment. Next, open debt. This is the least common type of debt, but I would like to go over it anyway. This is a type of debt that must be paid in full each and every month. A good example is a credit card that you're required to pay in full every month. The American Express Platinum, Gold, and Green cards are common examples. Your credit history, also known as time on file or credit file age, accounts for roughly 15% of your score. The reason why it impacts 15% of your score is because lenders know that the older your credit is, the more stable it is. This age is determined in two ways. One, the age of your credit file and the average age of the accounts on your credit file. The age on your credit file is determined by the oldest account's date opened, which sets the age of the credit file. Secondly, the average age is set by averaging the age of every account on your credit report, whether open or closed. Another significant factor of how your credit scores are calculated is account diversity, which is also known as types of credit used. This is approximately 10% contribution to your credit score. Your credit score will benefit by having a diverse set of accounts on your credit file. Having experience across multiple account types like installment, revolving, auto, mortgage, credit cards, etc. is generally a good thing for your scores because you're proving the ability to manage different types of accounts. Next, and one of the smallest parts of your credit report, is the search for new credit, also known as credit inquiries. Each time your credit is pulled by anyone except you for a permissible purpose in search of credit, it has an impact on your credit worthiness and your scores. A soft inquiry is when you pull your own credit and it does not impact your score. However, when someone else pulls your credit, it's considered a hard inquiry and it's visible to lenders and credit scoring models. Keeping inquiries to a minimum on your credit report can help your credit rating. A lender may perceive many inquiries over a short period of time on your credit report as a signal that you're having financial difficulty, and they may consider you a higher risk. Again, inquiries are about 10% of your score. Let's do a quick recap. 35% is payment history, which mainly consists of negative or positive information. 30% is debt, how much you have and what type. 15% is the length of your credit history. This is how long you've had credit. 10% is credit diversity. This is the different types of credit and experience you've had. And 10% is inquiries. This is when a creditor checks your credit report. Keep in mind, there are many different types of credit scores. Each one uses its own scoring model. We've touched on this subject a couple times throughout the course of this first lesson, but I wanted to go ahead and dig just a little bit deeper because it's so critical to credit. Debt is the single most critical factor on your credit. I'm going to repeat this again because if there's anything I really want to stick in your mind, it's that every dollar of debt you owe is considered a risk factor. The more debt you owe, the more likely it is that you will not repay it statistically, and every dollar of debt will hurt your credit. Another tidbit that you should remember is that different types of debt have different impacts on your score. Revolving account balances hurt much more than any other type of debt. This is primarily due to the fact that the accounts, once paid off, can be reused again. Again, credit is a numbers game and everything is a mathematical and statistical conclusion. Credit scoring models use these complex mathematical algorithms to determine the likelihood of repayment, which in turn determines the risk assessment. Ideally, keep your balances at zero on your revolving accounts. Installment and secured accounts hurt less. These may include homes, vehicles, or personal loans. As long as they're not revolving like credit cards, they will have a lesser impact on your credit and your credit score. All right, so here are a few tips to optimize and increase your credit scores. Of course, you only want positive and accurate information on your reports. If you do not, your credit's going to suffer. If you have mistakes, inaccuracies, or outdated information on your credit report, there is a way to fix a lot of that. If you have negative information on your report, obviously you should begin repairing it. But there are also ways to minimize those items even if you are not successful in removing them. First, make sure you have a good mix of accounts. You should have at least one installment loan and 3 revolving credit cards. But make sure you keep your revolving balances low. Pay down your revolving accounts such as credit cards first. Try to keep them either very low or zero balances. Remember, you have to play to score. If you do not use revolving credit cards every couple of months, they may stop reporting. Credit card companies pay to report your account information to the credit agencies. Accounts that are idle or show no activity will stop being reported. I always recommend that you buy a small ticket item with each card every 90 days or so to keep them reporting. So you can use your accounts, but just keep your balances as low as possible. If you've been paying on time, most creditors are happy to increase your credit lines. That's right. Some of them do it automatically, some don't. Try calling your credit card company every 6 months or so and tell them that you'd like a credit line increase. Okay, so your oldest accounts are your most valuable when it comes to credit. So it's important that you keep them open. Even if there is a yearly or a monthly fee, consider keeping them open because closing an old credit card can damage your score. Another important tip is opening and maintaining new accounts that report to the credit bureaus, and it's a key to building a solid credit rating. There are many different types of accounts that you can be approved for, even with a poor credit rating. Typically, you'll pay a higher interest rate, higher fees, or you may have to secure the account with collateral such as money or assets in order to open accounts if your credit is less than perfect. Credit history accounts for about 35% of your credit score. Therefore, if you don't have sufficient credit history, you need to open new accounts and pay the price if you ever want to increase your scores. We've covered a little bit about inquiries earlier and how they impact your credit. Each and every time you apply for credit, an inquiry will appear and it can drag your credit scores down a few points. So try not to apply for credit unless you're either trying to build credit or you absolutely need something. Lastly, make sure your personal information is accurate and up to date. This includes your name, address, previous addresses, social, date of birth, and employment history. When lenders or potential employers pull your credit, they may check to make sure the information that you placed on your application matches what the credit bureaus have on file. If not, they may consider you a higher risk or turn you down for the application or the job that you applied for. There is a technique that does work and not many people know about it, and many of those that do really don't understand it enough to make it actually work. I'm going to explain this in detail for you. So one of the fastest and easiest ways to add instant credit history to your credit report is by piggybacking. There's 2 different ways you can piggyback. 1, as an authorized user, or 2, as a joint account holder. Now, each has its advantages and disadvantages, and I'll explain exactly what those are. What is piggybacking and which method should I choose? Well, piggybacking is a technique that allows you to inherit someone else's credit history by being added to the account, typically a credit card. Piggybacking can season your credit and increase your credit scores faster than almost any other method. When the general public caught on to this trick a few years ago, it spawned an entire industry to meet consumer demand. There are companies that you can pay to piggyback on a complete stranger's credit card account. They call these companies trade line dealers. They pay cardholders to rent out spots on their credit cards, but only as authorized users. Some credit card companies allow 20 or more authorized users, so the trade line dealers charge anywhere from a few $100 to a few $1,000s to rent out these spots. The authorized user never gets the actual credit card, but the account will typically show up on their credit report. Now, eventually, the banks, lenders, and credit scoring providers caught on, and the scoring models shifted the weight of authorized users to minimize this practice. With that being said, authorized users on most cards do not carry much weight, and they have a much lesser impact unless the primary on the account is a family member or a spouse of the authorized user. So this is how it works. First, find someone that you really trust, okay? Someone that you trust with your life, because this person, they must have a credit card account with a major bank in good standing with low or preferably no balance. Also, you want to choose an aged account, one that has a really long history. The older, the better. And finally, the primary must be willing to add you to the account. I say in good standing because you don't want to inherit a negative account, right? I said preferably low or no balance because if the account has a high balance or it's maxed out, it's only going to hurt your scores. It's going to increase your utilization. Lastly, I mentioned that you want an aged account. Why is that? Well, the older the account is, the longer the payment history is, and the more it'll help your credit. Okay, so now that you've chosen the right person to help you out with the right credit card, now your friend or family member calls the credit card company and requests to add you as an authorized user or a joint account holder. You need to pick one. The credit card companies are usually more than happy to add someone else to the account. So you should choose authorized user or joint account holder. Which one should you choose? Well, that really depends on a few things. Just try to remember this. 1, credit scoring models will not place much weight on an authorized user account unless the primary is your spouse or a family member. Secondly, as an authorized user, you have zero liability. If the account ever falls behind, has late payments, or the primary maxes out that credit card, you can have it removed from your credit just as easy as it was to add it. Just call the creditor and ask them, and they'll remove it from your credit report. Now, on the other hand, if you choose to be a joint account holder, you are permanently responsible for the card forever. Okay? It's really important that you make sure that the primary account holder is a responsible person and intends on paying on time and keeping the balance low. Otherwise, there's a really good possibility that you're going to end up with problems. As a joint account holder, if the primary maxes out the account, is late, goes to collections, gets a judgment, or files bankruptcy, you are equally responsible for it, just as if you co-signed. Unlike an authorized user, you cannot simply ask to be removed. It's permanent, so just be very careful. Next, be sure that you monitor your credit reports to make sure it gets reported to the bureaus. Provided you did everything correctly, this account should show up on your credit report within the next 30 or 60 days or so. The next time a lender pulls your credit, it will recalculate all 3 credit scores and include the account just as if it was yours. The entire payment history will appear in your credit report and will be calculated into your new scores. I've personally seen this technique work wonders to boost scores, but I've also seen it cause catastrophic problems, not only with credit scores, but relationships with friends and family. My best advice to you would be to make sure you take your time, your due diligence, and be careful who you share accounts with. So there you have it. We've reached the end of lesson 1. That wasn't so hard, was it? What I'd like you to do now is read all of the text on the next page, then take the quiz, and I'll see you in the next lesson.